Hello, everyone, and a very warm welcome to today's major markets update for Wednesday, December 11, 2024. Question is the big tech rally that we are experiencing dangerous for the market? Because the Dow Jones was down today and pretty much everything else was rallying. It was really a big tech, except for Apple. But Apple is a bit extended, and I think Apple can still move higher from here, but that's something entirely different. So it's a big tech only, with only, ideally between parentheses, a dangerous rally. Well, please remember that divergence is only divergence until it is not. Meaning, yes, we have negative market breadth under the hood. There are some divergences on the technical indicators, but all of those are conditions. Price is the final arbiter. And for those that are my premium members, you know that we broke below several warning levels, 1 and 2 at best, for all indexes. And that means we have had a proverbial shot across the bow. So that means it increases the odds that the larger third wave is underway. All I'm saying increases the odds. We didn't say the wave 3 has been confirmed. It has absolutely not. And these divergences under the hood can entirely be erased by a strong rally. So now that market breadth has been so negative for a while, it can become positive and the market can continue to rally and extend. The market can always extend. It doesn't have to stall at the 123.6 on the higher or the 138.2% extension. It can go to 161.8. Just because it is in a ending diagonal pattern doesn't mean it has to follow textbook standard Fibonacci based patterns. It can do something else as long as, of course, wave 4 cannot go below the start of wave 3, which is the end of wave 2. That's pretty much all there is to it. For the rest, wave 3, of course, cannot be the shortest. Those are the two rules, and for the rest, it can do whatever it wants to do. And that then market breadth is not great. It's a tech-only rally. All those things are in the end immaterial because price is the final arbiter, and I can't stress it often enough. Yes, we've seen some down days, right on time, right on cue, right? Seasonality set a top around the December 7, but that's about it. We cannot trade off of seasonality. It is a general roadmap. We keep it in the back of our minds, but that's about it. All we trade is price. We don't trade time, not at all. That's why I'm definitely not a fan of options, because you get burned one way or another most of the time with options, because you need to get both price and time correct. Most people suffer tremendously with trying to get price correct. So that is really the two questions we have. Is this big tech only rally dangerous? And of course, is this divergence that we're seeing under the hood dangerous? Well, again, divergence is only divergence until it is not. I mean, it's a long story, but I must hammer it home because most people fail to understand this completely, in that they think, oh my God, we have this divergence. We got to run for the hills. Not at all. It is a warning sign. Forewarned is forearmed, but it can take 2 days and the whole divergence is erased with a strong rally, because in this case we're dealing with negative divergence. So question is, are we 4, 3, 4, 5? Where exactly are we? So are we still wrapping up this last fifth wave and then a pullback? Well, we're still missing the larger 4. We're still missing the larger fifth wave. This bull market ain't over. That's for sure, 100%, in my humble opinion. So that means that we can never be 100% reliable because we don't know exactly where the market is within its waves. Okay, so that we cannot predict with 100% certainty, so we can never be 100% reliable. Always keep that in mind. So that's why we queue off of price levels that help us. So while tech was rallying like crazy, except Apple, the Dow was down. Okay, that's not too great, you'd think. Divergence again. But now the Dow is getting oversold. So from here, we can still see another rally. Okay, this leg here from the November low can easily extend. Not until we go below that November low can we confirm technically the red wave 4. Okay, yes, there can be enough waves in place, but the market can always decide to subdivide, just as it did from the green wave 4 low here, A, B, C. Okay, so we can do another A, B, C. God knows. I don't know. Nobody knows if that's the case. Okay, just because we completed 5 waves up doesn't mean we can tag on another 5 waves. Okay, we've seen this continuously happening all the time. We must break below pretty much 43,000, a little bit south of it, to consider this rally complete, because that's a lower low. Until then, we can still do an A, B, and C and still go to that upper end of the ideal target zone in a very, again, ending diagonal pattern. And this would then match with what I shared from Pretzel before. This, let's see here if I can find it real quick, this ending diagonal pattern, okay? Same here, right? You can always tag on another ABC. So then we've completed this leg lower, we're gonna do another 3 legs higher. Okay, so please be aware that is entirely possible. That's why we say, okay, well, we've got our warning level broken, the first one. That means there's radar lock. All right, the enemy, the bear in this case, because we're in a bull market, has a radar lock on us. We broke below the second warning level yesterday. All right, we got the proverbial shot across the bow. We hear the bear growling in the bushes, but that's about it. Okay, not until we go below 43,000 can all hell break loose, so to say. But even then, we still expect only a 4 and still a 5. So is this wave 5 of 3 complete? Potentially, but possibly not. I cannot tell you other than, yes, we can still extend. It would not surprise me if we're going to extend. So back above last week's high, and we're going to go to the higher levels into the 46 to 48,000. Very simple. Similarly here, the ABC is extended. It might actually become a 1, 2, 1, 2, 1, 2 kind of setup. Okay, very possible this C wave is extending. So the next target is now 21,868. That's pretty much what we knew already. We broke below the first warning level. We did not even break below the second warning level. Okay, so that was it. All we got was like, all right, radar lock. That's it. Shuffle your feathers and you're good. And here we are on our way to 2868, and we can easily extend it to 22,460. Yes, we have these negative divergences on some of these technical indicators, but the trend is 100% your friend because it's 100% bullish. Yes, we are in all these target zones, but we can always extend. So we need to break ultimately below, I would say here, 20,600 to consider red wave 3 complete, with a break below that 21,000 level being critical. As well, that would be a very good early indication. That's all it is to it, by the way, that we get an early indication of this red wave 4. Now that we're going to extend, this red wave 4 will most likely only stall at around 20,300 and not go to 19,950, because then we're at the 138.2, we go to the 76.4, and from the 76.4, we'll then go to the 176.4, assuming a standard impulse pattern for a diagonal. All right, so far so good. Semiconductors, yes, still wishy-washy. All we did so far, retest of the 200-day moving average. I can't make soup of this, still stuck between this wave count and this wave count. Very clearly, the warning levels for the bears are the wave 4 / A high. If it's the wave 4, then we must hold it at all occasions to allow for lower prices into the 4,500 level. If we break above it, we're going into the low 5,000s, okay? Somewhere around 5350 plus or minus 50. Above 5450, this red B wave 2 and this entire wave count needs to be reassessed. And this red B2 might need to be moved higher and further out with a more complex ABC pattern, a double zigzag. All right, so this is the best we can do for now. With the data available, this is the best wave count we can get. That it changes, yes, unfortunately, it can change based on new data available, just as a weather forecast can change. A week ago, it said that it would rain on Saturday, Sunday, and Monday here in the San Francisco Bay Area. All right, 3 days ago, they said now it's going to rain on Thursday. All right. So do we throw the whole meteorological service out of the window? No, they change the forecast because new data becomes available. Same we're doing here. We're forecasting. We change the forecast based on new data that becomes available. That's all there is to it. And the changes can only happen if we break below or above certain price levels. If you can't handle this, then I cannot help you. If you can handle this, and I know a lot of you can, then this is a fantastic tool. I'm up 50% for the year. So please don't tell me Wave doesn't work. And I know none of you have told me that because you're following me. So I know that you know that it works for you. And if you have questions, please contact me. I am here to help. Okay. I'm here to help. Wave can be very difficult. It can also be a beautiful tool when you apply it correctly. And even with the Wave, there will still be losing trades. That's fine. Keep the losses small, let the winners run, and apply it correctly. So the semiconductors is, to me, an index that is so nauseatingly overlapping. I'm not going to trade it. I'm not touching it. Even my ETF trade alert system gets flip-flopped a lot. It's just something that I won't touch. If you only do the ETF trade alerts, it's sometimes a little hard to understand what the environment is and that you can get signals that are often false. That's just the way it is in a overlapping sideways market. You can get a lot of signals because you can have a trading system that's very quick to give signals or very slow. And one way or another, you get either whipsawed a lot with quick signals or very slow, and you'll never really get in on time till things already start turning around because it's such a whipsawing market as well. So there you have it. You know, damn if you do, damn if you don't. That's the unfortunate nature, but our trading systems were great. They were in inverse ETFs for the Dow Jones and already locked in half of those gains, tiny levels. And we're still long on the TQQQs and fantastic trade once again today, raise stops, fully profitable, and we're in cash for the S&P 500, for example. So that's going really, really well. Wonderful. I'm very proud of that accomplishment. So that said, semiconductors, as long as we stay below 5150, we can allow for lower prices. Above, I would say 5100 here, the intraday high here made, I believe, on Monday. Excuse me, something is stuck in my throat. And that already increases the odds we're going to go to this 5350 plus level. Okay, so can't discern just yet. This looks really nice. If we can nail this, wow, I'm going to get a Nobel Prize in Wave. I wish that was available. If not, then we're going to have to choose this path. So again, it's quite diametrically opposed. And that's why I don't like it. It's too overlapping. It's all ABCs. And all ABCs are hard to trade profitably unless you're really quick and know exactly where we are at. Okay, that's really the bottom line. There's plenty of more money to be made in other indexes. So here we have the S&P 500. It's stuck between the Dow Jones and the NASDAQ 100 most of the time in its pattern. It's not always the clearest pattern. The Dow Jones and the NASDAQ 100 are clearer. I really often like to trade those myself. And as you can see, we're still a little bit below the all-time high at 6102, I believe it was. Let's go back a few days. That was last Friday. Oh no, it was 60.99.97, so almost 6100. Okay, still a little bit stuck below it, but you can see if we gap above it, we can target that 6150 to 6175 level. We go above that, we have to look at 6277 for a very extended C wave, but still normal third wave target. It's not normal for a diagonal, but doesn't have to be normal, right? We don't know that beforehand. Once this wave 3 was announced, we don't know beforehand where exactly it's going to top. So you start off with it's normal, but you expect normal, all right? And most of the time, nothing is normal, not in this market. So warning levels are still the same. As you can see, we just failed to close, I believe, below the second warning level. We stepped below it, and then I believe just at the close, the market decided, nope, we're not going to close below it. And then, of course, the inflation data was good, more inflation, but still within apparently good enough levels for the Federal Reserve to lower interest rates so we can get even more inflation. Wonderful. One way or another, we're screwed. That's wonderful. No savings and more inflation. Oh boy. Anyways, if we top out 138.2, 6150, we'll drop most likely back to 58.10-ish. And from there, we're going to go to 63.50. Bigger picture-wise, this bull ain't over. The bull from the August low, the bull from the 2020 low ain't over yet. Okay, we're still missing a larger fourth and fifth wave. IWM, I'm not going to say too much about this one, held the second warning level, and that's all there is to it. Also, this one, like the Dow Jones, can still extend. It can still go to 255, okay, even if it wants to. So we have technically, once again, enough scribbles in place to consider C of 3 complete, but we can always subdivide. We need to break below, of course, the mid-November low to confirm the red wave 4. That's the bottom line. Until then, all we do here is pretty much get rid of all these extremely overbought conditions, and then we can move higher. So let's look here at the McLaren oscillator for the S&P 500. So we're extremely oversold technically. We're minus 50. Okay, so there's plenty of room now back to the upside. So if this thing starts to move higher, it pushes the market higher. Okay, and then we're going to extend well beyond what is normal expectations. So please keep that in mind. So yes, we have all this divergence, but you can see, right? All this divergence means nothing. Most of the time, negative divergence don't mean too much for a bull market. Positive divergence mean a lot for a bull market. So that you have, for example, positive divergence between lows. Okay, so you see this low here and this low here, these type of lows, right? You see what an improvement in market breadth, but you haven't moved much. You see the cursor here in the April-May part. That's what you want to look at. Similar here, these oversold conditions. And we're getting quite oversold, but look what the market has done, right? So just because you're getting negative market breadth is not a trade trigger. Price is your trade trigger, always. This you should just use for a FYI. And now, as you can see, there's plenty of room to the upside left. So it would not surprise me if this puppy is going to rally, okay? Don't be surprised if that's the case. We know below which levels it's not going to be the case, but we haven't broken below any. I'd really like to see this thing below 59.60 to really start to suggest this wave 4 is underway. Until then, nah. Okay, yes, warning levels, warning signs galore. I covered that in the last webcast, warning signs galore. But those are just warning signs. Again, divergence is only divergence until it's not. So please do not trade off market breadth. Trade off price, because you're trading the S&P 500. You're not trading the McLaren oscillator of the S&P 500. As such, the summation index, which is the McLaren oscillator from today, added to that of yesterday, which was added to that the day before, is getting almost oversold. So also here, it seems like there's room for improvement, right? Yes, we have all this divergence. I know, but look here. I've pointed it out so many times. What did we get here in, let's see here, from April till June? Negative market breadth, rally. What did we get here the early part of 2024? Negative market breadth, rally. Big tech was leading. What did we get here in May and June? Negative market breadth, rally. Big tech was leading. What did we get here? Negative market breadth, big tech was rallying. So big tech's rally is, and everything else is going down, is not necessarily the reason to run for the hills. Not at all. So now we can honestly move higher. We have plenty of room to the upside left. We're almost getting oversold. Not saying it will. It will if we break higher. Then we're going to look for 61.48, 61.75 on the S&P 500. Above 61.75, I'll be looking for 62.75-ish. Above that, 63. Yes, then we get a massively extended third wave. It can happen, okay? I cannot predict the future. I go by standard Fibonacci-based impulse patterns and standard Fibonacci-based extensions of C waves, etc. And if they do not hold, then we're going to look at extensions. Super simple, okay? As long as we hold above, in this case, 59.60 and about 60.30, we're good. IWM, I have covered that one, sorry. And let's see here, AD line. Yes, AD line has divergence, okay? Hasn't been confirmed yet. But we also had divergence, negative divergence here between October and November, an even bigger divergence than we currently have. Completely erased, all right? That's what I mean. Don't necessarily hang your hat up on these divergences. See this? And what did price do? There, right? It went up. So you expect, wow, that's going to be a crash. Well, all we got was the November 15 low. So now, once again, we have a bit of a divergence going on. But that divergence can last for a long time. As you know, bear markets need many months of divergence before they finally kick in. Early or late 1920s, sorry. Huge divergence before it mattered. 10 years of divergence in the 50s and 60s. About a year of divergence in the late 90s and a couple of months of divergence in 2007. All of them led to massive declines, right? Eventually, as you can see here, this decline here lasted pretty much for almost a decade as well, with huge upswings and downswings. But this is what we need to see, and we haven't seen it yet. Summation index covered, McLennan oscillator covered, bigger picture trend model remains 100% bullish. The PMO buy all, sell all is in a sell, as you can see, but it's probably going to bottom out today. And then we had, again, a less ideal sell signal, just as we had a less ideal sell signal here in the November top into the November bottom. We might see the same thing once again. We had a early December top, and then we might have a mid-December low, and once again, we rally. Okay, we want to see better sell signals from the ideal level. That's about 100. Okay, these ones are a little less reliable. It's just the way things are. 60% of the time, it works every time. So that's the update for today. Again, big tech has been rallying. It's not necessarily a warning sign. Market breadth is technically now quite oversold, so there's room for improvement. So we might need to look to the upside as long as we hold above the warning levels. And the first warning would be a break below yesterday's low. Okay, Dow Jones is getting oversold, so that one might be ripe for a rally as well. Just because we have a full wave count to the upside, it doesn't mean we're instantly going to crater and correct 10%. It simply means that we have completed a leg higher and we're in a leg lower, which then easily can be followed by another leg higher. We can't predict the future. We must see below the November 15 low with serious warnings at slightly higher levels. For example, about, I would say, 20,600 for the NASDAQ 100, and for the SP 500 that would be about 5960, and for the Dow Jones that would be about 43,500, somewhere around there. And the semiconductor is still stuck between a rock and a hard place, because currently here in December is where we were in November, which is where we were in October, which is where we were in September, which was where we were in August and July and June. So this one has gone nowhere. So please be patient with this one. There are better indexes out there to trade. Again, some are getting quite oversold. So don't be surprised if we see upside below yesterday's low. Starts to increase the odds, though, that we are indeed in this fourth wave, which is still pending. And after 4, still comes 5. Take care, trade safe, catch you all later.